And our next guest sees no slowdown in sight for the market's growth. Let's bring in Bruce Richards. He's CEO of Marathon Asset Management with us at Post Nice. Nice to see you again.
Nice to see you, Scott.
It really is remarkable. And BlackRock does a deal, right, this week for HPS. I mean, what's the message in a deal like that in an environment where I haven't heard anybody suggest that this private credit run is going to slow down anytime soon?
It doesn't slow down, and BlackRock, managing nearly $12 trillion in assets, has the biggest voice in the room among clients and allocators based upon their sheer size and the great success that Larry Fink and Rob Capito have brought to the firm. And what they've said is, we're willing to pay $12 billion, or nearly 30 times FRE, which is fee-related earnings, to add private credit to the mix. And so we see private credit growing by about a 20% CAGR per annum for the next many, many years. So 4 years from now, Scott, private credit will be 2x the size it is today. 4 years hence, it'll be another 2x or 4x where it is today.
Okay, so what you're saying is that you think we're in the early innings.
We're in the early innings. Private equity's been around for 40 to 50 years. Hedge funds have been around 40 to 50 years. Private credit just came to the advent since the great financial crisis in 2008 and post-2008. So it's very early innings relative to other alternative asset classes. And most importantly, the most consistent returning asset class of all alternatives, earning about 12%, regardless of whether markets are up and down. It's been uncorrelated to markets. So we see it capturing a bigger part of the allocator's wallet. And also, when you look at the banks who owns tens of trillions around the globe in private loans, private credit is a force.
You still have, many highly credible people who are suggesting it's either in a bubble now, or it's going to get to that point, and when it rolls over, it's going to be there's going to be hell to pay. I think those were the words that Jamie Dimon said several months ago. I talked to Jeffrey Gundlach back in September. These are highly credible people. I want you to listen to what Gundlach told me and have your reaction to it. This was in September at Future Proof.
Without any doubt, I know that when the first question at a large crowd presentation is over and over again talking about private credit, I say, well, you're asking me that because you own a ton of it, right? You're an RIA and you've got your clients all in these funds. And of course now, I think somebody's trying to do a closed-end fund for private credit. It gets weirder and weirder. First someone's so bold as to want $1 billion fund. Then somebody wants to do a $5 billion fund. Now there's somebody doing a $25 billion fund. This is what the top looks like.
What do you think?
My comments? Well, all due respect to Jeffrey, the simple truth of the matter is fixed income, whether it's high yield or loans, or whether it's structured credit, ABS, RMBS, CMBS, a complex of that, yields around 6 or 7%. Private credit's delivering 12%. So there's a lot of very smart money, the allocators, that are speaking. And they're shifting capital allocations from traditional fixed income and credit orientation to private credit. And so that explains the whole story from the vantage point, because people talk their book, and I think that stands for itself. So as it relates to being a bubble, not at all. Mm-hmm. It's just early innings. It's just starting. The overall complex. We've just lived through some bubbles like venture capital breaking, and other asset classes like real estate asset classes breaking. Private credit has been the shining star, again, consistently generating 11, 12% net returns.
What if, as a result of, let's say, deregulation, the competitive environment intensifies to the fact where banks are just freer to lend more, so all of a sudden you have more competition in the lending pie? Is that a risk at all?
Well, I don't think it's a risk. Look, banks are probably a bit overextended with respect to the real estate exposure. They're looking to take down their private lending book. And so while I agree that deregulation is a big part of banks, and has been constraining the banks, it's not the regulation of lending in the credit markets that's the issue. It's all the other regulations they have to deal with that have been constraining the banks. So I wouldn't conflate the two. I think we will have deregulation for the banks, but I think the two can coexist where banks are lending and private credit managers are lending, and we're competing with business. And private credit will do certain types of loans that the banks naturally don't want to lend to. And so there's a natural circuit breaker as well, because when private credit is stepping up, like after 08 and 09, banks were stepping back. You need that for markets to function well, and so they do coexist well together.